Hey, finance folk! Welcome to the EU Finance Podcast. My name is Aidas Palubinskas, and I am your host. Today, I am on another field trip. Instead of the usual Commission studios, I am across the street at the EU Council studios, where I'll be chatting with Kyriakos Pierrakakis, the President of the Eurogroup and the Minister of National Economy and Finance of Greece. Whoa. What? What is the Eurogroup? The Eurogroup is the forum where finance ministers from the Eurozone countries meet to coordinate economic and fiscal policy for the Euro area. And its president, currently Kyriakos Pierrakakis, acts as a key voice and consensus builder among those ministers. While the formal decisions on EU economic policy are taken in the ECOFIN, the wider council format where all EU finance ministers meet, the Eurogroup gives the Eurozone members a space for frank, off-the-record discussion before those decisions get made. Now, if you follow EU financial policy, you will know that President Kyriakakis has emerged as one of the clearest voices on European competitiveness. He has called the Savings and Investments Union, quote, the most important political agenda in Europe today, end quote. And today, we go well beyond that one topic too. We'll talk about what the SIU actually is and why it matters for ordinary people and for EU companies. About why this time it feels different from previous attempts at capital market integration. We're going to talk about the politics of pooling supervision at the European level. Also about the role pension funds can play as long-term investors. We're going to go into banking scale and competitiveness. We're going to talk about the promise of digital finance to, in his words, compress distance across Europe. We'll talk about the digital euro, which he has called an existential project, and whether, hand on heart, he's optimistic that all of this can get done. You'll probably have noticed that I talk an awful lot about the Savings and Investments Union with my guests. Well, it's because it's indeed that important, and it really covers an awful lot about EU finance. Okay, let's bust right into it. Mr. President, welcome to the podcast.
Delighted to be joining you.
Now, before we get started, I'm just going to mention this because I'm sure some viewer is going to notice this. My right eye is swollen because I was viciously attacked by a wasp yesterday.
I hope it doesn't hurt.
It does. It just goes to show that our podcast is not AI generated because no self-respecting podcast host would do that to himself. So let's get right into it. The Savings and Investment Union. You have called it at a recent ECOFIN the, quote, the most important political agenda in Europe today. And you've also highlighted how hard it is to talk and communicate around this topic. So in plain language, how would you explain what the SIU is? Oh, I'm sorry for using the acronym, Savings and Investments Union. And why should our listeners, and more generally, your normal average European care?
Well, frankly, this is exactly what myself and my colleagues, the finance ministers of Europe, have been trying to do in recent time, try to explain exactly why this project is existential and would make a huge difference for the daily lives of citizens. It integrates the Capital Markets Union and the Banking Union, and I think I'm not breaking privacy by saying that at a recent dinner that we had with Jean-Claude Juncker, all the finance ministers of Europe, when we asked him what is the one project, the one thing that we should be focusing on, he said exactly this, the Savings and Investment Union, and targeting specifically the capital markets. It has many elements to it. It's not one, I would say, reform by itself. It's an accumulation of reforms that collectively remove barriers and create the single market in real terms for our capital markets and for our banks. Now, how do you feel this in your daily life? That's your question. How can it make a difference? Well, it depends on the specificity. It depends on the specific topic, the specific issue that we're trying to resolve. Say you're a startup creator in Europe and you want to scale up your startup. The experience that startup creators have or have had for recent years is that we have plenty of ideas, but scaling up in Europe isn't something that happens at the level that it should be happening. At some point, many startups in Europe become Delaware corporations, and at some point they require American mezzanine funding. And I'm not necessarily saying that this is a bad thing. I'm saying that it shouldn't be the nominal equilibrium, which we should have alternatives, many alternatives. So we have trillions of euros sitting in savings, in low yields. And they're not being channeled into investments, into the productive economy. Should we be able, by a series of technical reforms that are often quite difficult to communicate specifically, but should we be able to change that? Should we be able to fix, I would say, in quite simple terms, the plumbing of the European economy? Then this will unlock growth, channeling those more than 10 trillion savings into investment. And while we also remove the barriers that exist and we create a single market, a full single market in our capital markets, then this would add growth. This means at the end of the day, better jobs, more jobs, higher growth for our European economy at a point where, frankly, more elevated levels of growth is a sine qua non for every single member state of the European Union and for the European Union as a whole. Plus, the Draghi report, the Letta report have pushed us towards thinking about competitiveness and growth, towards leveraging our capabilities and creating European sovereignty, in effect.
And it also means that the savers that have those 10 trillion in their accounts, instead of being just savers, they're going to become investors and get a better return for the money. So it's just win, win, win.
Exactly. And this is why I described it as the obvious thing that we haven't done for quite some time, which would produce an overall dividend for the economy, for every member state, for Europe, and for every individual saver, for every European. And, there's also a cultural element there as well, obviously, because part of the core portfolio of my good friend, the Commissioner, Maria Luisa Albuquerque, is also financial literacy. And I'm now the Minister of Finance in Greece, but I also used to be the Minister of Education before. And financial literacy is also a sine qua non in managing this change, I would say, in the overall mechanisms, in the overall culture and structures that we use throughout the European economy. However, the potential is there. And if I were to describe it using an IT analogy, my description would be that the European economy has had the hardware for quite some time, but it lacked the software. The software being the proper policies, the proper rules, the full removal of barriers that exist in our capital markets, be that common supervision, be that all the other elements of what we describe as the SAU, because as you mentioned, it's not one reform by itself. It's an accumulation of many reforms, the Savings and Investment Union. But if we collectively do all of them, or versions of them, because they will require negotiations, discussions, implementation, if we collectively implement them simultaneously, the growth potential that can be unlocked is quite significant.
Okay, let's go. We've had the Capital Markets Union for years. And we've had progress, modest progress, but progress nonetheless. Now we have the Savings and Investments Union. Okay, ECOFIN is the one that takes the decisions, the EU Council format where the finance ministers meet. The Eurogroup, of which you're the president of, is the privileged forum for frank and honest discussion. And it's your job to find a consensus among the ministers. Now, you've called something the asterisks. And I would call it the yes, but, which is when member states essentially agree, but then they say, oh, we want an exception. Now, why or how are you going to get past that?
Well, I think there's a structural shift in mindset first. And the structural shift in mindset is obvious first at the level of the leaders. I think we all understand that the cost of being idle, the cost of not moving, is higher than the cost of any concession. And I think this is specifically the point for every member state, no exceptions. Second, in any such discussion and in any such debate, one needs to be respectful of those asterisks that you mentioned, because they typically reflect traditional ways that national economies worked. They typically reflect domestic institutional architectures. They reflect the equilibrium, the status quo that existed in every single member state. In order to convince someone to deviate from that, to move from that towards a new pan-European equilibrium, you need to fully understand the mechanics of this, and you need to show respect towards this because it reflects something which worked for a member state for a very long time. But frankly, and I think this holds even for the larger member states in Europe, no member state by itself is big enough to compete globally. I mean, if we're to make a broader analogy, a broader discussion than the SAU here, and think of the European Union as a whole, we need to deploy Europe's sovereignty. Sovereignty is not autonomy. Autonomy is a dimension of sovereignty. You exercise sovereignty through many mechanisms, through control perhaps, or through others. But broadly speaking, we need to capacity build at the European level. So this means a lot of things. It means that you need to create European champions, not only national champions. And this requires a cultural mindset shift. So this shift is very vivid and very obvious in capital markets, as you said before, because it can produce the obvious dividends. Plus, the barriers that still exist in Europe became quite vivid in the last negotiations that we had with the United States on tariffs, because I remember the IMF paper, which was also presented at the Eurogroup, which said you're discussing tariffs bilaterally with the United States as Europeans, but at the same time, the IMF has calculated that the barriers that you still have in services are equivalent to having a 110% tariff between the 27 member states of Europe. So why don't you start by getting your house in order? Well, this description member states grasp, finance ministers grasp, leaders primarily grasp, and they fully understand that there is a quite important opportunity cost in front of us right now. Plus, this is part, again, of a broader puzzle, of a broader discussion, of a broader mosaic, as we would say. And there, I would also add that the era of geopolitical innocence for Europe is over. We understand that since Russia's invasion in Ukraine, we understand that in a rapidly shifting geopolitical environment where we need to build new relationships, where we need to capacity build many elements of our policy at the European level and pool capacities and capabilities centrally. So starting from this north in the compass, when one looks at what we can do, short run, medium run, and long run, and what is feasible with regards to achieving progress, I think that this specific area is one where most progress can be made most quickly. And this is what people understand. Final point on this, what can the Eurogroup do? I think that it's quite essential and existential to deploy and develop a common vocabulary when we're discussing certain things. We don't need to agree on everything, but it's very crucial and very important to have a common vocabulary when we're trying to describe the same phenomena. Once we describe in problem definitions, solutions typically follow, and we can find a common ground in the development of those solutions. So be that in the recent energy crisis that we have had, where we try to see what's the impact of the energy crisis from the Middle East and what types of measures we need to take at the European level, or be that the reforms that we need to do in our capital markets or in our banking system. On all of those things, if we manage to describe and agree upon the problem definition in common terms, then it's easier for the solutions to follow. So I think part of my job as president of the Eurogroup is to define the working program, the discussions, the presentations, and what we're all engaged with in order to develop a common terminology about the problems that we're trying to handle. And this is what I've been trying to do so far in the first semester of this year that I've been serving as president of the Eurogroup. And I feel that we're also quite expanding the scope of what we're discussing because, frankly, the Eurogroup became famous in countries like mine for the management of the sovereign debt crisis in the previous decades. So it focused on fiscal matters, fiscal stability, and obviously the elements of our monetary union that are commensurate with the role of the ECB at the level of the finance ministers. This is critical. This is existential. We need to continue doing that. But at the same time, as finance ministers, we need to have an opinion on technological innovation. We need to have an opinion on energy. We need to have an opinion on housing, which is a core problem in every European state. Well, when you look at all of those issues, there is a common policy element which plays a role in each one of them. Having unified capital markets and having a deployed banking union, which is effectively the SIU. If you think about technology and scaling up startups and deploying innovation, you need to have those trillions of savings deployed in the European economy to be able to enable the companies to scale up. And you need this change in the way we operate with regards to our investment priorities and investment decisions. So all of those things collectively require a common policy, a common horizontal policy, which is the deployment of the SIU. This is why I called it the most existential project, the most existential policy project of our generation. It's the necessary condition in order to achieve everything else.
Okay, if you had to pick one reform in the SIU as the most important or a key reform in the package, which one would it be and why?
I think it's common supervision. And
you're jumping into my next question. Okay, supervision is indeed probably the thorniest issue in the Savings and Investments Union, or the buildup to it. And in the recent Markets and Integration and Supervision package, when you were talking about, you said, a capital markets union without adequate supervision is like a monetary union without the European Central Bank.
Indeed.
And you've said it publicly, that it is obvious that we should not be doing the same thing 27 times. I
run the risk of repeating myself when you're asking this, but true, I feel exactly the same way. Plus, if I were to add one point to this, the level of technological innovation that we currently have in financial markets, think of stablecoins, think of the implementation of MiCA, of the regulation that we have at the European level, which is the relevant one for managing stablecoins in the European economy. It's very difficult to emulate this 27 times and to capacity build our public institutions 27 times. Plus, there are certain things which it makes more natural sense to supervise on a central basis, at a central level.
But the problem is that we know this from the past in the European Union. Again, it's a yes but, in the sense where a member state has been supervising like this and like that since forever. And they're perfectly happy with the way that things are going for them. So why give it up? Why give up that power?
Well, because the opportunity cost of not doing it is extremely elevated, and I'm very respectful of my colleagues and of the member states that have concerns, given their national sensitivities, obviously. So I'm saying this with respect, but in my view, that's why my country, speaking now with my Greek Minister of Finance hat, took a stance of aggressively saying yes to this. We already have a model. You mentioned the ECB, which I used as an analogy, as I used an example. We still have our national central banks that supervise below a certain level, but above a certain level, you have the ECB, you have the SSM, you have the mechanisms of the monetary union that are put in place, and they are working, and they're working well. So we have this analogy that we can draw from, plus technological innovation, I think, is the key parameter that drives many of the decision-making process. And this is why, by the way, I want to integrate technological discussions more at the context of the Eurogroup and for European ministers. Because once you have those innovations, for instance, on stablecoins, the distributed ledger technologies, tokenization, once you have all of those things in place, you need to have very strong institutions at the level of Europe, effectively, to be able to govern them. And this governance is quite tricky. It's quite challenging and quite difficult. It's not very easy to do this in 27 member states simultaneously. Who, for instance, will tell you that some type of regulatory shopping would be avoided between the 27 domestic regulators from a company that's trying to locate in each one of them? To give you one example, it makes much more sense to pool resources centrally, and it can unlock even more potential. You cannot have the SIU without some significant level of centralized market supervision. That's my thesis.
That makes sense. Makes sense. Okay, we recently did a podcast on the supplementary pensions package. And that's also part of the Savings and Investments Union. You recently said that the SIU is not just about markets, that it's about creating strong European institutional investors with a long-term outlook. Supplementary pension funds, including occupational pension funds, are precisely that type of investor, that patient investor, as I like to call them. What are the benefits of such funds for the citizens and for savers, and more generally for the European economy?
Well, on the one hand, they can supplement, they can augment the available financing capabilities that you will have as a pensioner, given the demographic problems. It can be quite beneficial for every European citizen per se. Plus, frankly, more funding can be channeled at the European economy. A big part of that 10 trillion that I mentioned before is managed actually by institutions that are relevant to managing pension funds. The IORPs is the acronym, if I remember correctly, and they manage more than 3 trillion euros. So those 3 trillion euros, how are they managed? Well, they're managed today quite conservatively, to be frank. They don't invest enough in private equity, in venture capital. We need to remove any barriers that exist from enabling them to make those investments at the level and at the scale that it would be necessary. So there is an element which is important, I think, for every European pensioner, for every European retiree. The demographic problem is one of the most acute problems that Europe as a whole will face, and is already facing, but it will face it more strongly in the coming years. So you need those pensions packages to supplement the architecture of our pension system on the one hand, but on the other hand, channeling those funds at the productive economy, I think, is an absolute necessity. You see it happening on the other side of the Atlantic. So what should the work be? The work should be, let's remove any unnecessary regulatory burden for allowing this to happen. And this is why, as we discussed before, the SIU is an accumulation of reforms that need to take place. And this is, I think, one of them. And it's one of the areas basically where progress is being made through the supplementary pensions package. The Council has agreed on a negotiation position on the pan-European pension product. So we see progress happening on that front, and it's a progress that we will be supporting further.
Got it. Let's turn to banking. As you know, the Commission is presenting a report on banking competitiveness in mid-July. Now, I don't know how much you can comment on this because I'm
sure it's not already there.
I'm sure you've discussed the issue with finance ministers. And you, in the past, have notably declared that the EU needs larger banks, that it needs scale. What would you like to see the banking report focusing on? And where do you think most change is needed in banking regulation?
Well, first of all, let me explain why, in simple terms, why scale is existential. Scale is existential for any industry. That's why, as I mentioned before, we need European champions rather than national champions at the level of Europe, because you need to grow your players in the business space to be able to compete on a global basis and on a global scale. Now, what is the core driver of this? The core driver of this, frankly, in every industry is technology. So if there is one PowerPoint slide that was quite important and quite interesting in the presentation that we had at the Eurogroup with my colleagues, it was one where we made a comparison on the investments in technology that European banks are making compared to the ones in America and the ones in China. And we're making less investments in technology if we make this comparison right now. Why are we making less investments in technology? Well, because frankly, our banks are smaller than theirs.
Is it just a matter of size, or is it a matter of culture?
It is not only a matter of size, but we need to start fixing all of the conditions. So one of the conditions that we need to fix is to enable more cross-border consolidation in banks. We know that we need that. This is an overall consequence of the Draghi report, right? It says that you need European champions, so consolidate on a cross-border basis. So you need to remove the barriers that prohibit your, not necessarily prohibit you, disincentivize you from doing this. But it also has a very strong cultural element, as you say, because typically, we had the culture of having a tacit need, a tacit predisposition to have national champions in the banking space in each one of the member states. We have some big pan-European banks, but we need to see more cross-border consolidation. And the second slide from that presentation that I can comment upon is the fact that cross-border M&As in banks in Europe have more or less declined since the financial crisis. So those two things, technology investments and cross-border M&As in banks, I think are quite critical. So the question is, if we define this as being a core problem that we need to fix, what stems from this? Actually, what should we be doing? What should a policymaker do? Well, basically what an engineer does. Reverse engineer the problem. Find the problem that you want to solve and reverse engineer it to find the solution. And this will define the policy that you want to advance. So we need to re-examine certain things vis-a-vis supervision, vis-a-vis what makes this cross-border consolidation easier. There are certain cultural elements as well, which we need to signal. Switching to my Greek finance minister hat here for a moment, I can tell you that I'm quite proud for two things that happened in my country in the last 1 year and a half. The first one being, which is not banks per se, but I think it's a very strong signal, Euronext acquired the Athens Stock Exchange. I recently heard Chancellor Merz saying that Europe should ideally have one stock exchange. This is part of the SAU, very significantly and very critically. And currently, I can tell you, using a very real-life example, that Greek businesses, Greek companies feel the difference of being part of the Euronext network and being part of a broader liquidity pool for themselves.
Sure, it opens up...
It opens up the economy, it opens up the domestic market, and they have more opportunities. So they feel that. Now, I'm not necessarily saying that reaching an equilibrium of a single stock exchange in Europe is something very easy to happen in the next couple of years. Perhaps we will have 2 or 3. But this is an area where we need more consolidation. So this is one example that I would quote. And the second one being that UniCredit acquired more than 30% of one of the 4 systemic banks of Greece, Alpha Bank. And I think this was a strong signal as well, because we wanted to showcase that we believe in those cross-border banking consolidation. This was William Faulkner's advice to young writers: show, don't tell. So we're trying to show that this is something that should be happening. And the more member states start doing this, and the more citizens in those member states start seeing the benefits of this, we stand to gain from this. That's my core point. So there are certain symbolic elements which are being ceded once you have those asterisks that we discussed before removed from the table. But my claim would be that if we look at the economic value, and as a consequence, the social value, because more growth means better jobs and better paid jobs. Once you see that happening as a consequence of reforms and as a consequence of opening up, and as a consequence of effectively implementing the agenda of the SAU, then politically it makes much more sense to do this integration and to catalyze those consolidations and scale up. There is a phenomenal benefit in scaling that effectively helps every single member state regardless of size. We all stand to win from this. That's my point.
Okay. I hear you using the words technologies, opportunity, and that immediately brings me thinking about digital finance, because that's where people are most likely going to be getting their opportunities or realizing their opportunities through electronic banking, digital finance, essentially. And you've got a really cool quote about digital finance, which I found. Quote, digital finance can do something profoundly important for Europe. It can compress distance.
Yes.
I love that compressed distance idea. Could you explain it a little bit more for our listeners?
Well, let's move one step back first and then go straight to this. What are we trying to achieve here? Well, technology is disrupting every field. I think that we can all agree with that. So it's certainly disrupting payments. It's also disrupting currency. The question for us is how to augment the capacity, the international role of the euro, broadly speaking. And there we have a huge success. The euro has been a phenomenally successful project institutionally and financially. The question is, how do you continue to evolve the project once context changes? And the context is changing through technology. And you mentioned my quotes, but one of my favorite quotes is from Giuseppe de Lampedusa, from The Leopard, who says that for everything to stay the same, everything must change. So we need to continuously adapt ourselves to keep the euro at a very important position and to even leverage that position, to even make that position even better. So this is the philosophical standpoint. Now, what is happening in the financial sphere? Full disruption through technology. What are the strategies that each country is deploying? They're different. Some countries are trying to deploy more private innovation. Some are focusing more on deploying public infrastructure. On the one end, you have the United States of America. They have not opted to create a digital version of the dollar, but they have a strategy which is focusing a lot on stablecoins, the Genius Act. And they're using the Genius Act and they're using stablecoins as an instrument of their economic policy. But the focus is private innovation.
Okay,
let's go.
Maybe I'm jumping too far ahead, but is the digital euro then the answer?
I would say yes, that it's the core element of the answer. Because on the other end, you have China, where they're only focusing on the deployment of the public infrastructure and not on private innovation and digital payments. And in the middle, it's us, because we're trying to do both. What is the core strategy when you're trying to do both? You have the digital euro on the one hand, and you have MICA on the other, which is the framework which can enable and unleash and unlock private innovation. On the digital euro, I think it's quite important to have this public infrastructure for many reasons. It can create a competitive advantage. On private innovation, we're starting, if we look at stable coins, from a disadvantage. 95% of stable coins are dollar-backed, less than 1% are euro-backed. So the question is, how can you unlock more private innovation on that sphere? Well, we already have lots of innovation fragmented to a certain extent, which we need to bring together on the payments sphere in Europe, which tries to compress distance. We have in many countries national payment systems, which are trying to act as our national alternatives to international schemes of payments. And they're quite successful domestically. Now they have started interoperating. I think this is a complementary situation to the digital euro, but the value that can be unlocked by having a singular public infrastructure in Europe for payments, for distance compression, for allowing you to be able to use that system in every single corner of Europe. And this being A, secure, B, trusted, and C, efficient, can unlock a very significant value which can further leverage the international role of the euro. So it has, I would say, a payment side, an innovation side, which is the distance compression side. It has a transparency side. Needless to say, again, using my Greek hat, that I come from a country which managed to generate those quite important surpluses that it has right now and have the most de-escalating debt in the world, not only in Europe, to a very large extent because we created a digital financial ecosystem. We had tax evasion in Greece. And now using digital payments all over the map enabled us to capture part of the informal economy, part of the tax evasion significantly, channel that into the real economy, into the productive economy, and have surpluses generated. The value of this is immense. I'm not suggesting that all European countries had the same challenge that my country had, but having a digitally transformed, innovative, transparent, trusted system only unlocks value.
Okay, trust. Now, one thing that I've noticed in my job, when I read all the financial papers and I follow discussions that are going on in the member states, I've noticed that the digital euro has actually generated an awful lot of projects from non-friendly countries that are feeding disinformation, feeding arguments among people and distrust for the digital euro, saying that it's going to be a big brother thing, that the governments are going to be able to see what we're buying and control us that way, et cetera, which obviously isn't true, but that is being stoked. And so how do you respond to normal people who say, yeah, well, I don't want the digital euro because the government's going to know everything about me?
Well, my response is that technology deployed correctly, broadly speaking, can be a game changer for the daily lives of citizens, serving them better, eliminating bureaucracy, and making their lives far more easier. We live in an environment where we have very strong institutions. In Europe, we have GDPR for privacy, the General Data Protection Regulation. We have a framework which protects privacy, I would argue, more than in any other place in the world.
Absolutely.
So this is a very strong component of our cultural identity in Europe, which is a foundation upon which we build any other policy. But technology, and I'm saying this as a former digital minister as well, is actually humanistic because it helps create a better state and a better government overall. Before we move to finance, broadly speaking, states, governments have never been designed. They have occurred to a very large extent. They were produced by an accumulation of thousands of laws in many decades, which do not have a design element within them. So one of the things that we did in my country was to start redesigning processes and services to citizens through a government platform. Part of it had to do with, part of our policy had to do with digital payments and capturing tax evasion. Part of our policy, the core part I would argue, had to do with simplifying, had to do with putting all the services that mandate physical visits to public services, make them digital. If I were to say it in one phrase simply, go Estonia. But the way through which you go Estonia, through you become a fully digital state as Estonia is, the path is different for every country because you have a different path dependence, a different history. So all of those things, once you deploy them, also in the economy itself, with digital payments, with the digitization of banks, once this is fully integrated, this is a state that actually works. and a state that actually works better for everyone because it eliminates distance. And primarily, this helps those who are most in need. And I think this is a truly and fundamentally social policy at the end of the day. So this is my answer to everyone who is a skeptic, be that in the digitization of payments or be that in the digitization of pretty much anything. We have the culture and the identity that allows us to do this right. And we have to do it right.
Mr. President, in all the research that I've been doing to get ready for this podcast and finding your cool quotes, I've come to the conclusion that you are an optimist. Am I right?
You remember Churchill's quote? I'm an optimist because there is no point in being anything else. But that's a pessimistic quote at the end of the day. I am an optimist because our problems are the inverse of our opportunities. And once you see a change in context, a change in vocabulary, a change in the world that we live at, which mandates us to force change, I think that it falls upon the shoulders of this generation of policymakers to deliver all the projects that have been discussed for a very long time, like the one that we're discussing today, like the SIU. And frankly, every policymaker in Europe, or pretty much in the world right now, is facing a duality. On the one hand, we need to resolve the outstanding issues of yesterday. On the other hand, we need to be agile and we need to be able to react with speed, with nimbleness and speed on all the emerging challenges of today and tomorrow, on the things that you cannot predict. So on the one hand, we need to deliver all the reforms, all the changes, all the things that we have been debating for years, like the Savings and Investment Union, the capital markets and the banking element. And on the other hand, you need to have governments and institutions in Europe that are agile and strong enough to respond to the emerging challenges of AI, to the energy crisis in the Middle East once the Strait of Hormuz is closed, or to any other unpredictable geopolitical, economic, or technological element. This is the structure of our challenge. But the level of the challenge, the higher it sets the bar, for the delivery of solutions. This is what the citizens ask. I think that we are developing the vocabulary and the common understanding that this needs to be delivered and needs to happen now. And I'm optimistic that it will.
Mr. President, thank you so much for coming to chat with me. I really appreciate it. I've learned an awful lot. Your enthusiasm and optimism is indeed infectious, and I thank you for that.
Thank you so much.
Okay, here's my take on this. President Kyriakos Pierrakakis is someone who manages to be both a realist and an optimist at the same time, which, believe me, in Brussels is not as rare as you might think. What struck me most in this conversation is how he frames the SIU not as a technocratic project, but as something with a very direct impact on the lives of ordinary Europeans, people like you and me. With savings sitting in a bank account earning next to nothing, wondering if there is a better way. 10 trillion euro. That is the number I keep using because I can't get over how big it is and how important it is. That's money that could be working better for European savers, European workers, European business. And the SIU is, at its core, an attempt to put that money to work for European citizens and for the European economy. The politics are hard. The asterisks, the yes, buts are real. But if the momentum he describes at the level of European leaders is genuine, this could actually be the time things move. I hope so. I am indeed an unrepentant, optimistic realist. That's all for today. Thank you for being with me. It's appreciated. Do please leave pleasant comments, like and subscribe. And if you enjoyed today's chat, tell someone you care about to listen to this episode. As always, there's more information in the show notes. Until next time, bye.